Hi folks, I'm Rick Wedell. I'm the Chief Investment Officer with RFG Advisory in Birmingham, and I thought given the recent market volatility that we would just reach out with a brief market update. The S&P 500 is down about 4% for the week, which certainly caught a lot of people's attention, and most of what is driving that is a combination of concerns about trade and as well as concerns over the shape of the yield curve. Before we dive into those, I'd like to talk about volatility for just a little bit. In any given year, the S&P 500 has, on average, about 60 days where it moves 1% either to the positive or to the negative. And year to date, we've actually had only about 25. So believe it or not, despite the most recent bout of volatility, this year has been less volatile than your average year, which is a weird way of saying that the volatility that we've seen over the past couple of weeks is actually normal for the market. It's normal for the market to go through these periods. Corrections happen, movements down of 5% happen, and that's to be expected in any type of market cycle. So let's talk a little bit about trade. We continue to have this most recent bout of volatility got kicked off on August 1st, effectively when we threatened to impose additional tariffs beginning in November. We've since walked that back, but there continues to be a war of words between both sides. At certain times we'll say things that are inflammatory and then we'll walk it back. At certain times they will respond in an inflammatory way and then they will walk it back. And I think the market obviously moves in response to these things. And why does it? Well, because these tariffs fundamentally slow down our economy's growth. Anywhere from 20 to 50 basis points of our economic growth is currently being held back by the imposition of these tariffs, and it could get worse than that if we impose additional tariffs. So the market definitely reacts to it, and so long as we continue to have this war of words between the two parties where sometimes we're going to be friendly, sometimes we're going to be nasty, we're going to continue to see this market, sort of whipsaw between the two. Last but not least, we should just talk a little bit about the yield curve. Briefly, earlier this week, the yield curve inverted, and what that means is that investors demanded more to lend money for 2 years than they demand to lend money for 10 years. Normally, you would think about the normal shape of a yield curve. You get more money to lend money, you get more yield to lend money for longer, and in this case, you're getting less yield. It's generally thought that when this happens, that the bond market is scared about economic growth. And it is true that most recessions have been preceded 18 to 24 months in advance by a yield curve inversion. So a lot of people look at this as a predictor of, hey, we might be looking at a recession in the next 18 to 24 months. I have a couple of things to say about that. The first is, while it's true that most recessions were preceded by yield curve inversions, it is not true that every yield curve inversion has subsequently been followed by a recession. So we've had a couple of different head fakes. We had one in 1998, we had one in the early 2000s, where a yield curve happened and then a subsequent recession was more like 3 or 4 years away, not 1 or 2. Second thing that I would say is that on average, the equity markets enjoyed about a 15 to 20% return between when the yield curve inverted and when the recession actually started to occur. So it's not like it's an indication that equity markets are going to be completely flat between here and whatever event might happen. And the last thing that I would say is that we are dealing with one of the most manipulated yield curves in history, right? Since the Great Recession, almost every central bank has engaged in efforts to try and manipulate either the shape of the yield curve or just manipulate long-term rates, which is not something that we saw in prior cycles. And so it's a little bit questionable, it's a little bit spurious to me as to whether or not the yield curve shape is going to be an accurate predictor in this cycle, or as accurate it was in historical cycles, given that there is so much manipulation of the curve today, which didn't exist previously. So with that, I hope you guys have a wonderful next couple of days. And as always, if you have any questions, please feel free to reach out to me or to your advisor. Thank you so much.